This is shocking. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, Vanguard's shocking announcement leaves its customers speechless and is 2018's riskiest trade back. We'll show you why investors are piling into this and why it's likely to blow up in spectacular fashion, just like it did in 2018. And is the world's second largest economy about to take another turn down? We'll show you, based on some brand new data, why the worst is yet to come for China. Now, with Vanguard, we can find out that the CEO's surprise exit raises some big questions for the investment giant, leaving the biggest question is, why is he going out at a time like this when the company is really growing at a massive pace? Could it be just a simple wanting to get out at the top? Maybe there's some unforeseen risk that it sees that investors are coming. Well, we've got the answer to that, because it could be based on what's really going on underneath the market. And what's really going on in Vanguard? Well, the investment giant's 50 million clients have good reason to ask that question following the unexpected retirement of Tim Buckley. At age 55, he announced he would leave the company and end at the year. And Buckley and Vanguard have given no warning, offered little explanation, and have declined interview requests, catching many people by surprise, wondering what is going on at the investment giant. But again, could this just be a simple case that investors are taking too much risk in this market? We'll make the case it's not just the biggest trade since 2018. There's a whole nother factor here. Maybe Buckley's just looking to get out before things blow up in big fashion. And Buckley's tenure at 6 years has been relatively brief but notable. Assets under management surged by more than 80% to a whopping $8.7 trillion. At the same time, customer complaints about technology and service quality moved to the fore. But is that enough to give him an unknown reason to leave the company? No. We'll turn to Goldman Sachs now, because there's possibly a bigger risk. I think this is just a simple explanation. Buckley realizes the best time to get out is why things still look good. And Goldman asked the question, are we in a bubble? Well, we could be in a mega cap tech bubble. Leaning on a great note from Ben Snyder, we frame how concentrated things are relative to history. And here we can see on this topic, it caught Goldman's eye that the S&P equal weight registered its first all-time high in over 2 years last week. And concentration within the U.S. equity market has surged to a multi-decade high, as the 10 largest U.S. stocks now account for 33% of the S&P market cap and 25% of S&P 500 earnings. And this takes us back to Vanguard's story here. Maybe Buckley's just realizing that all of the investors and all of the products they sell have their clients over concentrated in risk. And the reality is they don't have an answer. But his answer may be get out while getting is good. Because when we see markets that are over concentrated, it usually doesn't end well. And concentration with the S&P 500 has surged to the highest level in decades, and earnings are consensus forward 12-month estimates showing that the market cap of these stocks is well outpacing its earnings. This is dangerous. We can go back to the tech bubble and see the last time this happened. Well, we know what happened then. Of course, the NASDAQ blew up in spectacular fashion by around 80% to the downside. This would not be a good look for Vanguard at all. But one thing that investors can do is look to diversify elsewhere, and we give you all the tools to do that with our reports, and we give you some spectacular numbers to go with that to show you how you can beat the odds. We have two ways to do this. One is our CTA Timer Pro. We take a look at the machine positioning every day, 7 days a week or 5 days a week. We do this. Obviously, not open on the weekends, but we look at the machine positioning and we find dislocations in the market because we run a historical overlay. And when the machines start buying out of a deep short position, that's your signal to buy. We give you those signals, and as you can see, we even put in video showing you how to trade it to make it so easy if you've never traded before. And if you like to trade the technicals, well, we've got a report for that. It's called Momentum Timer Pro, because the risk is people find out when they trade technicals, they get in late, they get out early, they're bouncing all over. We change the game by taking multiple signals, aggregating them together, putting a proprietary signal that no one else uses to smooth the data all out, and we've got impressive results here. We show you when to get in and tell you how to get out as well. As you can see, we include videos with that, and I ran some tests going back to February 28th, taking every trade through March 8th, not duplicating on any trade the report made. So if it gave a signal and 3 days later gave a secondary signal, we took the first signal at market open, just like we tell our subscribers. Here's what happened. We generated 34 trades between the two reports. 25% closed up by March 8th, 9 down. That's a 74% win rate. You want to get ahead of the markets. You want to avoid the next big downturn. You want to make money trading in the easiest way. Check out the links in the description below. All my competitors, they give you 7 days to try their reports. We give you 30 days. Why? Because we know after 30 days you'll make money and want to stay. That's the bottom line, because one thing that's not going to last is this mega cap rally. During the past 12 months, the aggregate market cap weighted S&P 500 has rallied by a whopping 30%, but the median index constituent has just risen by 11%. This means the largest stocks have been the major drivers of S&P 500 returns in the recent years. And we know that when everybody gets concentrated in one investment, and this is what money managers like Vanguard have no choice to do. You want to keep pace with your competitors, you have to give these big stocks into your portfolios. This causes overconcentration. And when something changes in the market, which could be, of course, the next recession, well, that means everybody's got to get out. And when everyone tries to exit the market at the same time, stocks just outright plunge. We'll give you some of the catalysts behind this move, because here we can see today's top stocks trade at much lower valuations. This is, of course, the plus, why everyone says this is okay and it can keep rallying. The largest stocks did at the tech bubble peak, but compared to the largest stocks in the early 1970s, called the Nifty 50, today's top 10 have similar valuations, but much higher profit margins and return on investments. The question then remains is there something that could change those profit margins? Well, many investors believe profits are only going to go higher. We'll show you why it's all because of the Fed. Then we're going to make the case of why that's just not likely to happen, as Fed officials to signal interest rate cuts are getting closer. And this is a big deal for equity investors who believe that just a couple cuts of rates here will cause equity prices to surge, will drive profit margins even higher. That is exactly the issue of the economy, as rates are just slightly too high. You pull back on them a little bit, the next thing you know, you just send the equity markets roaring. But history suggests that's not the case at all. And yet the Fed is widely expected to hold interest rates steady for a fifth straight meeting when policymakers gather next week on March 19th and 20th. Of course, we'll cover that, and when it comes, much of the focus by investors will be on the Federal Open Market Committee's quarterly forecast for rates, including whether fresh employment and inflation figures have prompted any changes. Keep in mind, those forecasts are worthless. They're never accurate at all. The Fed never follows them. What matters is economic fundamentals here, which is why we'll talk about China later in today's show, where it's headed. The rest of the world will follow. And should the Fed officials pencil in 3/4 point reductions for 2024, which is now largely expected, it will set the stage for a potential cut in June, as investors are betting on. And of course, that means a lot of equity investors believe stocks can surge. But again, history shows that this isn't likely the case. We come back to Buckley here, the head of Vanguard, taking this just unannounced exit. Well, here may be the biggest reason why, because when the Fed starts to cut, it is never a good sign for the equity market, despite the fact that that is the popular belief. You go back to the 1990s, what happened? The Fed starts cutting, market goes down. It gets a little more obvious here as we get into the tech bubble of the 2000s. The Fed starts to cut. What happens? Market does come back and rally, doesn't actually make new all-time highs. Well, and then goes down from there. As we look at the federal funds rate, that in red, against the Wilshire 5000 price index in blue. And what do we see here? The global financial crisis. This is obvious. Fed is cutting, stocks blow up. Happens again as we lead into the pandemic. And then now investors think the opposite is going to happen. But again, you start to look at companies like Vanguard and their competitors. They've got all their clients in over-concentrated positions in these top stocks. This is a dangerous move. This is something that perhaps Vanguard just doesn't have an answer for its clients. Maybe Buckley doesn't want to ride that wave down. The report also includes signs of continuing moderation with downward revisions to prior month's gains showing wage growth and an increase in unemployment rate to a 2-year high of 3.9%. The data probably took some air out of the danger of the Fed having to delay and scale back cutting, and this is the hopes that everyone has, is that perhaps the Fed is going to see the data slowing, and all we need to hear from Powell is, look, just give us a little more time, and then we'll have to trim a little bit, and then the economy will smooth out as we get right back to the neutral rate. Of course, don't ask him what it is because he doesn't know. But Powell said his assessment being not far from enough confidence to cut is still intact, suggesting that indeed we'll see the Fed starting to cut around June. But when they do, it won't just be 1, 2, maybe even 3. It's going to be a whole lot more because the economy is likely to head lower. And again, we take a look now at the consumer price index. We get an update on that tomorrow against total compensation in red. You know, we hear the Fed talk about slowing wage growth, and sure enough, that is indeed happening. Now, we look at hours worked as well, as we see it here in total compensation in red, which is average hourly earnings multiplied by average weekly hours of production and non-supervisory employees. That on a year-over-year rate of change against the consumer price index in blue. What do we know? There is indeed a downward trend in total compensation, and that goes along with the lag, a downward trend in the CPI. I'm not expecting any big moves by the CPI next tomorrow, but it does suggest that the trend for the index is to continue to head down. As it heads down, well, that's not a good sign for the equity markets because many people believe that softer inflation here is a boon for the economy. It only works if wage growth and hours work continue to stay elevated, but at the rate they're growing, they're going to continue to head lower. And all this is setting up now is for one of the biggest trades that blew up in 2018 to blow up again as investors are piling in. As one of the most infamous trades on Wall Street, well, it's roaring back. People say they learned their lessons. Well, we know throughout history that doesn't seem to be the case. And here we see that something known as short volatility bets, they were a key factor of the stock plunge in the early 2018 when they wiped out in epic fashion. You would think, of course, companies wouldn't offer these products. You think investors wouldn't want them. Well, they're back in a different guise and at a much, much bigger scale. And this is dangerous because those who got wiped out then are going to face another wipeout event. Of course, when that happens, it's going to pull stock prices straight down. Their new form largely takes the shape of ETFs that sell options on stocks or indices in order to juice returns. Assets in such products have almost quadrupled in 2 years to a record $64 billion. Their 2018 short vol counterparts, well, a small group of funds making direct bets on expected volatility, only had about $2.1 billion before they imploded. Now, of course, what the belief is that Wall Street got the math right, they figured it out, and this is now a safe way to invest. We know that never works out. The more money that piles into these speculative investments, well, when things do go wrong, and what would be that catalyst? Well, would be a bear market here, would cause that to blow up. We can go back and look at the Fed cutting rates, when then it makes sense. Why would Buckley, the head of Vanguard, at its peak here, want to just quietly disappear? Maybe he knows what's coming and doesn't want to be a part of it. The bad news is that the positions alongside a stack of less viable short volatility trades by institutional players are suspected of suppressing stock swings, which invites yet more bets for a calm feedback loop that could one day reverse. Again, we saw it happen back in 2018. So any notion that this can't happen again, well, that's not true. The strategies are also part of an explosive wider growth in derivatives that's introducing new unpredictability to the market. And every simple sense here is we can't have another bear market because we don't know how all this speculative stuff ends. And we do have a bear market. We will find out. Unfortunately, the odds are it's going to be in spectacular fashion, just like before. Because the most famous episode took place in February 2018, when a downturn in the S&P 500 sparked a surge in the VIX, wiping out billions of dollars in trades betting against volatility that helped built up during years of relative calm. Among the biggest casualties was the Velocity Shares daily inverse VIX short-term note, or better known as XIV, whose assets shrank from a whopping $1.9 billion to $63 million. Well, that happened overnight after market close. That was a dangerous move then, and we're looking to set up a dangerous move now. And that's one of the key reasons why we have to look at the world's second largest economy, because we're making a case here of why things are headed down, and as investors pile into riskier and riskier trades in these top mega cap stocks, they're only facing what is going to be the inevitable, and that's assuming a risk. And the fact that the risk hasn't materialized over the past 1.5 years doesn't mean it doesn't exist. That's something many people believe. Well, the recession's not here, and it hasn't been here, and many people like you, Steve, have been calling for it, so that means it cannot happen. It's not going to happen. They take the same approach to investing, and certainly if something trips up the market, which could be the next bear market, the next recession, the next global financial crisis, the longer the volatility has been suppressed, but we do know throughout history, the more violent reaction that could send stocks outright crashing. That could be bad news for Vanguard and its customers who have no options, who have taken on excessive risk by the company's investment products. Again, you make the case, why would Buckley want to get out? Well, there'll be other people who look to get out on the top, because what's going on now with China suggests that the second largest economy in the world, that many people believe has started to stabilize, is about to take another leg to the downside. And that's not good for the global economy. As we see, iron ore plunges the most since 2022 as inventories are now piling up in China, suggesting that demand is going away. And that's one of the key things. A lot of people are saying, oil prices have been driving higher because China is buying oil. That means they know demand there's going up, unless they're actually just hoping demand is going to follow all their purchases. Now we see iron ore piling up, and it's tumbled around a quarter from the peak in early January as China's real estate and manufacturing activity remain under pressure. The annual National People's Congress in Beijing, which concluded Monday, offered a few prospects of demand boost. There's a key. Few prospects of demand boost, and iron ore stockpiles at ports have ballooned to the highest in a year, making the case many people say we can't have a global recession. You're seeing it happen right now. Little by little, it's adding up, just like those short volatility trades. The plunge in steel making ingredient was the most since mid-2022 on an intraday basis, and it was headed for the lowest close since August last year. And over the weekend, Beijing reiterated its stance that the homes its residents live in are not for speculation, keeping to its longstanding position, even as a property crisis weighs on demand, suggesting that Beijing just doesn't realize how bad their situation is in their property developers and how tied it is to the banks. Maybe they think this comes out okay. Maybe they think a little bit of stimulus, a little bit of demand, a little bit of pushing by the banks to lend will stabilize the property market. It doesn't look like that's going to happen at all. And this clarification came after Premier Lee government work report draft admitted the slogan, "Housing is for living in, not for speculation," for the first time since 2019. And all this does is set up more deflation in China as we see a brief reprieve, likely temporary, due to the weak demand. Again, we see these terms, weak demand. We're going to start seeing that about all the major economies around the world. And as that happens, where do we go next? The Fed rate cuts and central bank rate cuts. What follows in is equity prices go down. Then what happens? We see banks start to hemorrhage. After that, equity prices come crumbling down. There you get the unwind of all these speculative trades around the markets. And last year, China's economy suffered its longest deflation streak since the Asian financial crisis because domestic demand remained weak even after the country reopened from COVID and production ramped up. That's led to price wars in sectors from cars to fast food and added to worries over record low consumer sentiment amid job cuts and falling home prices. Deflation pressures will likely persist unless household income improves and the property downturn is turned around. Of course, we know the property downturn isn't likely to turn around. And we talk about incomes here. And this is why I showed you the U.S. data, because what are we seeing? A continued slowdown in wage growth. We're seeing average work continue to trend lower. The idea that we're going to see a resurgence in inflation amidst weaker consumer demand, it's unlikely. And they're figuring this out in China now, as much of the improvement could be proved temporarily. rather than sustainable, as further policy efforts are essential to foster and consolidate the price momentum. That means turning the price momentum to the upside. Beijing doesn't want to stimulate, but they're likely going to have to. By the time they do, it's too little, too late. And now we come back to where we started the show. Why is Buckley, the CEO of Vanguard, quietly stepping away without any reason? Well, it could be he just wants to get out before the storm hits. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.